Key indicators such as wage growth, services inflation, and consumer demand will shape the Fed's next move. Breaking news from the world of finance. The Federal Reserve is now facing one of its toughest challenges in decades. It's a high-stakes balancing act, a tightrope walk between taming rampant inflation and preventing a full-blown economic recession. Every move they make is under intense scrutiny, and the consequences of getting it wrong could be severe for all of us. This isn't just a headline for Wall Street, it's a story that will impact your wallet, your job, and the future of the economy. So, what exactly is happening, and why is the Fed in such a precarious position? Let's dive deep into the numbers and the decisions that will shape our financial future. Recent economic data has painted a very confusing and contradictory picture for policymakers. On one hand, we're seeing some positive signs. Inflation in certain areas, like goods and energy, has started to cool off. This is the good news the Fed has been hoping for, suggesting their aggressive interest rate hikes over the past couple of years are finally starting to work their magic. However, it's not a clear-cut victory. In other crucial sectors, particularly services, inflation remains stubbornly high. Think about the cost of things like rent, healthcare, and dining out. These prices are not coming down as quickly as we'd like. This persistence is a major headache for the central bank. But here's the real twist in the plot. While the Fed has been trying to slow the economy down, the American consumer and the job market have been surprisingly resilient. Consumer spending continues to be robust. People are still going out, traveling, and buying things, which keeps demand strong and, unfortunately, puts upward pressure on prices. On top of that, the employment market is holding up remarkably well. The unemployment rate is still near historic lows, and companies are, for the most part, still hiring. While that's great news for workers, it complicates the Fed's job immensely. A hot labor market means wages can continue to rise, which can fuel more spending and, you guessed it, more inflation. So the Fed is looking at an economy that's simultaneously showing signs of cooling and signs of overheating. This mixed bag of data makes it incredibly difficult to chart a clear path forward. Do they continue to apply the brakes, or is it time to ease off? This brings us to the core of the dilemma. Why does this delicate situation matter so much? It's because the Federal Reserve is walking a razor's edge with enormous consequences on either side. Let's consider their options. If they decide to cut interest rates too soon, thinking they've won the battle against inflation, they risk a massive backfire. Lower rates make borrowing cheaper, which encourages more spending and investment. This could easily reignite the inflationary fire they've worked so hard to extinguish. We could see prices surge again, forcing the Fed to reverse course and hike rates even higher later on, causing even more economic pain. The ghost of the 1970s, when inflation became deeply entrenched in the economy, haunts every one of their meetings. On the other hand, what if they wait too long? What if they keep interest rates high for an extended period to make absolutely sure inflation is dead and buried? This path is just as risky. High rates are designed to slow down the economy. They make it more expensive for businesses to borrow and expand, and for consumers to take out mortgages or car loans. If rates stay high for too long, that gradual slowdown can turn into a sharp downturn. The economy could contract, leading to a recession. Businesses might start laying off workers, and the unemployment rate could spike. The Fed would have successfully killed inflation, but at the cost of millions of jobs and a significant economic slump. This is the classic hard landing scenario that everyone wants to avoid. Ultimately, the Fed's credibility is on the line. If they make the wrong call, it could erode public trust in their ability to manage the economy, making future crises even harder to handle. The stakes truly couldn't be higher. So, how are the financial markets reacting to all this uncertainty? In a word, volatility. The bond market, which is highly sensitive to interest rate expectations, has been on a roller coaster ride. Bond yields, which represent the return an investor gets from a bond, have been swinging wildly. One week, a piece of data suggests inflation is cooling, and yields fall as investors bet on rate cuts. The next week, a strong jobs report comes out, and yields shoot back up as those bets are unwound. This constant recalibration is a clear sign that even the so-called smart money is struggling to predict the Fed's next move. The equity markets, or the stock market, are equally on edge. Stocks have been reacting sharply to every new piece of economic data. A positive inflation report might send the S&P 500 soaring, while a speech from the Fed chair that sounds even slightly hawkish can trigger a market-wide sell-off. Companies in different sectors are also affected differently. Tech and growth stocks, which are more sensitive to borrowing costs, tend to suffer when the market fears higher rates. Conversely, more defensive sectors like consumer staples or utilities might hold up better during times of economic uncertainty. The VIX, often called the market's fear gauge, has remained elevated. This index measures expected volatility, and its high reading tells us that investors are braced for more big swings in the near future. This persistent uncertainty makes it a challenging environment for investors, as the market's direction can change on a dime based on the latest headline or data point. It's a trader's market, full of short-term noise that can be very distracting for long-term investors. With so much hanging in the balance, what should we be watching now to get a clue about the Fed's next move? There are a few key indicators that will be absolutely critical in the coming months. First and foremost is wage growth. The Fed is keeping a close eye on how much workers' paychecks are increasing. If wages grow too quickly, it can create a wage price spiral where higher wages lead to higher prices, which then lead to demands for even higher wages. The Fed wants to see wage growth moderate to a level that is consistent with its 2% inflation target without crushing the labor market. Another crucial area is services inflation. As we mentioned, while goods inflation has come down, the price of services remains sticky. This includes everything from haircuts and car repairs to airfare and insurance. Because the services sector is a much larger part of the economy and is more closely tied to labor costs, the Fed needs to see a definitive cooling trend here before they can feel confident that their job is done. Any signs of persistent strength in services inflation will likely keep them in a hawkish stance. And finally, we need to watch consumer demand. Are people continuing to spend freely, or are they starting to pull back? Indicators like retail sales, consumer confidence surveys, and credit card debt levels will provide important clues. If demand starts to falter significantly, it could be a sign that the Fed's high rates are really starting to bite, raising the risk of a recession and potentially pushing them toward a rate cut. Conversely, if spending remains strong, it will support the case for keeping rates higher for longer. The interplay between these key data points, wage growth, services inflation, and consumer demand, will ultimately shape the narrative and determine whether the Fed chooses to combat inflation or pivot to supporting growth. The next few months of data will be absolutely pivotal. Thank you so much for watching. This is a complex and evolving story, and we'll be here to track every development. If you found this breakdown helpful, please hit that like button and subscribe to the channel for more in-depth economic analysis. Let me know your thoughts in the comments below. Are you team inflation fighter or team recession avoider? See you in the next video.